Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the International Corporate Accounting Questions and Answers 2 of 2. Hope you will like, share and special request to all to don't forget to subscribe our channel. Cash flow and fund flow statement. Cash flow statement. The cash flow statement shows the inflow and outflow of cash from operating, investing, and financing activities over a period of time. Fund flow statement. The fund flow statement is similar to cash flow statement. The difference being in fund flow statement will show inflow of funds and outflow of funds rather than cash over a period of time. CAPM. CAPM or Capital Asset Pricing Model helps investors figure out how much returns they should expect from an investment based on its risk. The simple formula should be expected return is equals to risk minus free rate plus V multiplied by market return minus risk minus free rate. What it means? Risk-free rate. Risk-free rate means safe returns you would get from a risk-free investment like government bonds. Beta or B measures how risky the investment is compared to the market. If B is equals to 1, the stock moves like the market. If B is more than 1, the stock is riskier than the market. Whereas if B is lesser than 1, the stock is safer than the market. Market risk premium. E in bracket again in brackets RM minus RFE R underscore M minus R underscore FE RM minus RF. Extra return investors expect for taking market risk. For example, risk-free rate is equals to 5%, market return is equals to 10%, stock beta is equals to 1.5. The expected returns would be 12.5% based on this formula. This means the investors should expect 12.5% return for taking the risk of the stock. Cost of equity. The cost of equity is the return that investors expect to receive from an investment in a company when estimated using CAPM as explained in our previous slides. Capital structure. Capital structure is the mix of a company's debt, equity, and other financial instruments used to finance its operations. Note: details on capital structure will be provided in our next video. Credit default swap detailed explanation. Credit default swap, or simply CDS, is a type of financial contract that works like insurance for loans and bonds. It protects lenders like banks or investors from the risk of a borrower defaulting, that's failing to pay back their debt. How it works. A lender or an that's investor A buys a CDS from another party, that's investor B. Investor B agrees to compensate investor A if the borrower defaults. In return, investor A pays regular fees, that's premiums, to investor B. For example, a bank lends $10 million USD to a company. To protect itself, the bank buys a CDS from an insurance company. If the company fails to repay the loan, the insurance company pays the bank the USD $10 million. If the company repays the loan, the insurance company keeps the premiums paid by the bank. Key points: protects against loans or bond defaults, works like insurance but is tradable in the market, used by investors, banks, and hedge funds. CDS became famous during the 2008 financial crisis as banks used them to bet on risky loans. Hedge fund. Detailed explanation. A hedge fund is a type of investment fund that pools money from wealthy investors and uses advanced strategies to make high returns. Unlike mutual funds, hedge funds can take more risks by investing in stocks, bonds, derivatives, currencies, and even private companies. Key features of hedge funds: exclusive to the rich. Only wealthy individuals and institutions can invest. Higher risk, higher reward. Uses strategies like short selling, leverage, and derivatives. Less regulation. Compared to mutual funds, hedge funds have fewer restrictions. 2 and 20 fee structure. 2% management fees charged annually on total assets, 20% performance fees charged on profits earned. Example of a hedge fund strategy: short selling, betting that a stock will fall in price. Leverage, borrowing money to increase returns. Arbitrage, profiting from price differences in markets. Famous hedge fund manager is George Soros, who broke the Bank of England, and Ray Dalio from Bridgewater Associates. Note: hedge funds are powerful but risky, high returns but potential for huge losses. Return on investment. Detailed explanation. Return on investment, or simply ROI, is a formula used to measure how much profit or loss an investment has generated compared to its cost. It helps investors and businesses evaluate the efficiency of an investment. Formula: ROI is equals to gain from investment minus cost of investment divided by cost of investment. The whole will be multiplied by 100. Example: you invest 100,000 US dollars in stocks. After 1 year, your investment grows to 120,000 US dollars. Your profit will be 20,000 US dollars. ROI will be simply 20,000 divided by 100,000 multiplied by 100, that's 20%. This means you earned a 20% return on your investments. Why is ROI important? Compares different investments, helps in decision making, measures business profitability. A higher ROI means a better investment, but risks should be also be considered. Financial leverage. Detailed explanation. Financial leverage means borrowing money that step to invest or expand in business, hoping to increase the profits. It helps companies and investors amplify their returns, but it also increases risk. Formula: Financial leverage is equals to total debt by total equity. Example, a company has 50 lakh rupees, Indian rupees in equity and borrows 1 crore rupees. Financial leverage is equals to 1 million divided by 500,000, which is equals to 2. This means the company is using twice its own money in borrowed funds. Benefits of financial leverage: higher profits can increase return if the investment grows. Business expansion: companies can grow faster without using their own funds. Tax benefits: interest on debt is often tax deductible. Cons of financial leverage: higher risk. If returns are lower than interest costs, losses increase. Debt burden: more debt means higher interest payments. Financial instability: too much leverage can lead to bankruptcy. A balanced use of leverage can boost profits, but excessive borrowing is dangerous. Corporate bond. Detailed explanation. Corporate bond is a type of loan that companies issue to raise money. Investors who buy these bonds lend money to the company in exchange for regular interest payments and repayment of the principal amount after a fixed period. Key features of a corporate bonds: issued by companies. Unlike government bonds, these are issued by private or public corporations. Fixed interest, that's coupon rate. Investors receive interest, that's coupons, regularly, usually semi-annually or annually. Maturity date: the company repays the full amount, that's principal, on a specific date. Credit risk: if the company struggles financially, there is a risk of default, that's not paying back the bond. Example, a company issues a 100,000 US dollars bond with a 7% annual interest rate and a 5-year maturity period. You buy the bond and receive 7,000 US dollars per year as interest. After 5 years, the company repays the 100,000 US dollars, that's principal. Types of corporate bonds: investment grade bonds, low risk, issued by financially strong companies. Junk bonds, that's high yield bonds, higher risk but offer higher returns. And of course, corporate bonds are less risky than stocks but riskier than government bonds. They are great for investors looking for fixed income with moderate risk. Initial public offering. Detailed explanation. Initial public offering, or an IPO, is when a company sells its shares to the public for the first time and gets listed on the stock exchange. This allows the company to raise money for growth and expansion. Now, how an IPO works. Company decides to go public, plans to raise funds from investors. They need regulatory approvals. The company files with SEBI in India or SEC in the US. Price is set either through fixed price or book building process. Public subscription. Investors apply for shares. Shares get listed. Trade Trading starts on the various stock exchanges around the world. Example: suppose XYZ wants to raise 500 million US dollars through an IPO. It offers 50 lakh shares at 1,000 US dollars per share. Investors buy shares and XYZ Limited gets the funds for expansion. After listing, the stock can be traded in the open market. Why do companies go for IPOs? The first and the main reason is raise capital for growth and expansion, increase brand visibility, allow early investors to exit, public trading of shares. IPOs can be great investment opportunities but also risky. Beta in finance. Detailed explanation. Beta is a measure of stock's volatility, that's risk compared to the overall market. It shows how much a stock's price tends to move in relation to the market's movements. Key points: a beta of 1 means the stock moves in line with the market. A beta greater than 1 means the stock is more volatile than the market. It tends to move up and down more. A beta less than 1 means the stock is less volatile than the market. It moves less than the market. A negative beta indicates the stock moves in the opposite direction of the market. Beta in practice. Beta is equals to 1. If the market goes up by 10%, the stock is expected to go up by 10% as well. Beta is equals to 1.5. If the market goes up by 10%, the stock is expected to grow up by 15%, more volatile. Beta is equals to zero point 0.5. If the market goes up by 10%, the stock is expected to go up by 5%. This is less volatile. Now, why beta matters? Risk assessment. Investors use beta to understand the risk of an individual stock in comparison to the market. Portfolio diversification. Investors might choose stocks with different betas to balance risk. For example, if you invest in a stock with a beta of 1.2 and the market increases by 10%, you can expect the stock to rise by 12%. Similarly, if the market drops by 10%, the stock would likely fall by 12%. And beta is widely used in the capital asset pricing model, that is CAPM, to calculate the expected return of an investment. Annuity, retained earnings, and goodwill in accounting. Annuity. An annuity is a series of equal payments made at regular intervals over a period of time. Retained earnings. Retained earnings are the portion of net income that's not paid out as dividends but reinvested in the business. Goodwill in accounting. Goodwill is an intangible asset that arises when a company acquires another for more than its fair market value. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share, and subscribe to our channel, Accounts and Finance with FARSK. Thank you. Have a great day.